Okay, so today we're diving into the recent Takeda Pharmaceutical Company H1 fiscal year 2025 earnings call. This was quite a key one.
Yeah, definitely. Held October 30th, pre-market US, intraday Europe. Lots to unpack.
Right. And our mission here is really to pull out the pivotal insights, because this call, it felt like a story of two halves, didn't it?
Absolutely. You had this pretty painful near-term financial picture, but then surprisingly strong cash flow execution underneath.
And that huge $11.4 billion bet on the future with Innovent. We need to understand how those pieces fit together.
Let's start with the headline numbers, the immediate snapshot. And yeah, like you said, they were tough.
Significant softness. Revenue down 6.9% year over year at actual exchange rates.
But even at constant exchange rates, CER still down 3.9%. They reported $7.32 billion against an $8.01 billion consensus.
That's nearly a $700 million miss. That's a serious miss.
It really is. And that top line pressure, it flowed straight down, unfortunately. Core operating profit, the COP, fell 8.8% CER.
Which dragged the core operating margin down too, right?
Yep, down 140 basis points year over year, landed at 28.8%.
Okay, but wait. The reported operating profit, the GAAP number, that plunged nearly 28%. That needs explaining. What drove that massive hit?
Yeah, that sharp drop was mostly an impairment loss they booked in Q2.
The platform exit.
Exactly. They decided to exit their early-stage gamma-delta T-cell research platform. It signals, cleaning house, focusing R&D dollars elsewhere.
For later stage stuff, presumably.
Right, but taking that write-down now really hurts the reported P&L. It was a $58.2 billion hit and non-tax deductible, too.
So P&L getting hammered by generics, this big write-down.
Yeah.
Yet the cash flow, adjusted free cash flow, FCF, was $525.4 billion.
Which is just phenomenal. That's a 112% increase year over year, a massive jump.
And operating cash flow up strongly too, 32%.
This is the core tension, the divergence you really have to grasp. How can the profit look so weak while cash generation is booming?
It tells you they're managing costs tightly.
That's part of it, yes. Tight cost discipline, efficiency gains are working, but it also shows they're collecting cash, managing working capital really well, even with shrinking revenue. They're building a war chest.
Okay, let's unpack the anchors dragging down that P&L. You mentioned generics.
Yeah, the loss of exclusivity, LOE, for VYVANSE. That was the main headwind. Management put a number on it, roughly $100 billion in lost revenue just in the first half.
That's huge.
It is. But the narrative from them is that the worst of that generic impact peaked in H1. They expect it to moderate quite a bit in H2.
So stabilization ahead, hopefully. What about the other anchor? Currency.
Right, FX. Transactional foreign exchange headwinds, mostly driven by the euro appreciating against other currencies they sell in.
Okay, break that down. Why does a stronger euro hurt their profit when they report in yen?
Well, think about it. They sell in euros in Europe, right? But when they translate those euro earnings back into their reporting currency, which is influenced by global FX, a stronger euro relative to where they incur costs or sell elsewhere can actually erode the value of those earnings.
Management said this FX dynamic accounted for about 1/3 of the core operating profit decline, even at CER. It's a significant external pressure.
And that combination LOE, the impairment, FX, forced them to reset guidance for the full year.
Correct. FY25 core revenue guidance is now $4,500 billion. That's aiming for broadly flat CER.
And the profit outlook.
Also trimmed. Core OP guidance went from broadly flat down to a low single-digit percentage decline. The target is $11,130 billion.
And as you mentioned, that big impairment really hammered the reported EPS forecast, cut down to 97.
Because that impairment wasn't tax deductible, so it hit the bottom line hard.
Now, here's my challenge, or maybe just a question on the narrative. Despite cutting EPS guidance so sharply, they kept the dividend unchanged, $200 per share. Progressive dividend policy cited.
Yep.
Is that genuine confidence in the FY26 recovery, or are they just trying to keep income investors happy while they wait for the pipeline?
It's probably a bit of both, to be honest, but I lean towards it being rooted in that incredibly strong cash flow. The FCF generation gives them cover.
Exactly. That 200 dividend is really important to their investor base. Holding it sends a signal. The H1 pain is temporary. It's a VYVANSE LOE. It's a one-off impairment. But the underlying engine, look at the cash flow, is strong enough to bridge the gap.
It's a statement that they believe they can manage through this dip until the new drugs hopefully kick in, starting FY26.
Precisely. They feel they control the timeline, even if the P&L looks messy right now.
Okay, that sets the stage perfectly for the strategic pivot. If they're generating cash like this, How are they deploying it? Which brings us straight to that massive Innovent Biologics deal.
The $11.4 billion global oncology partnership. This is the big swing for the fences.
A huge bet, $1.2 billion up front, including $100 million in equity.
Yeah, it's an aggressive, late-stage external innovation play. They're targeting two specific assets that seem quite differentiated.
Let's break those down. First up, IBI 363.
Right. That's a PD-1 IL-2 alpha bias bispecific. Now, the key here is the alpha bias part.
Less toxicity than traditional IO.
That's the idea. Traditional immuno-oncology can have significant systemic toxicity. This is designed to activate the immune system more selectively, potentially with a better safety profile.
And strategically, that lets them target
areas where current IO often fails. Think IO-refractory non-small cell lung cancer, NSCLC, and microsatellite stable colorectal cancer, MSS-CRC. Really tough to treat cancers.
the unmet needs.
Absolutely. They're planning 5 phase 3 trials, and they've outlined a 60-40 profit-loss split for U.S. co-commercialization. It's a cornerstone bet for their future oncology franchise.
Okay, asset number 2. IBI 343, that's an ADC, right? Targeting CLDN 18.2?
Correct. An antibody-drug conjugate. Think of it like a guided missile delivering chemo directly to cancer cells expressing Claudin 18.2.
Which is prevalent in...
GI cancers,
Yeah.
gastric, pancreatic primarily. Again, very difficult areas. The data presented earlier seemed really promising.
Not promise.
Well, in some studies, they reported doubling overall survival and response rates compared to standard chemo. You just don't see that kind of delta very often in these cancers. Takeda clearly saw high caliber potential here.
So the Innovent deal is the big long-term reload. But what about nearer-term catalysts to bridge that gap? FY26 isn't that far away.
Good point. Management highlighted progress there too. They confirmed positive phase 3 data for oveporexton, their narcolepsy drug. That's on track for filing.
Okay.
Then there's rusfertide for polycythemia vera. It got breakthrough therapy designation, and they plan to file in the second half of FY25.
So potentially impacting FY26 revenue.
That's the plan. And also, phase 3 data for zasocitinib in psoriasis is expected by the end of this calendar year, 2025. Those 3 are key for near-term growth momentum.
And there's always a but, isn't there? This whole growth story kind of relies on their existing blockbusters holding the line.
Yeah.
And we saw a wobble with Entyvio.
Yes, that was a noticeable flag. They revised Entyvio growth guidance down from 9% CER to 6% CER for the year.
That's a big deal for their largest drug. Why the slowdown?
Management gave 3 reasons. First, more competition, especially in Crohn's disease where newer drugs are making inroads.
Okay, makes sense.
Second, channel mix shifts things like 340B pricing and Medicare Part D dynamics impacting net price.
Standard industry pressures then.
Sort of. But the third one was maybe more concerning from an execution standpoint.
Yeah.
Slower than expected conversion to the Entyvio pen.
Ah, the self-administered version. Why is that slower? Patient resistance, physician inertia, commercial issues?
They didn't specify exactly, but slower uptake means they aren't capturing the convenience and adherence benefits as quickly as hoped. It definitely clouds the near-term picture for Entyvio.
And likely contributed to the market reaction. The ADR was down almost 4% on the day.
I think so. Despite management trying to frame H1 as the peak pain from VYVANSE and pointing to cash flow and the Innovent deal.
The market focused on the here and now, the revenue miss, the guidance trim, and now this Entyvio slowdown.
Exactly. It reinforces this idea of FY25 being a true pivot year. Absorb the hits, LOE, FX, pruning the portfolio.
And hope the pipeline execution comes through for FY26, especially rusfertide, oveporexton, and getting those Innovent trials running fast.
Right. And just quickly before we get to the trade idea, they did touch on margins in their plasma-derived therapies, PT business.
Yes, the plasma business, margins improving.
Yes, continued recovery confirmed. But interestingly, they emphasize it was driven more by efficiency gains rather than just building new collection centers.
Efficiency like what?
Specifically, they cited 10-11% higher collection volumes by using personalized nomograms.
So using data on individual donors to optimize how much plasma they can safely and efficiently collect per visit.
Precisely. Smarter collection, better yields, more profitable growth without just relying on capital-intensive expansion aligns with their overall focus on cost discipline.
Okay, interesting detail, which I guess brings us to the point where we look past the immediate noise and throw caution to the wind a bit.
Indeed. Our not financial advice segment, remember everyone, this is purely for discussion, an outrageous but plausible idea.
High conviction, maybe a little wild.
The trade idea is go long Takeda ADRs, ticker TKA. But the timing is key. Time to the next critical data point from that Innovent partnership.
Okay, explain the thesis. The market right now is valuing Takeda based on
the rearview mirror, the VYVANSE LOE hole, the FX headwinds, that $11.4 billion Innovent bet. It's largely being treated as show me the data money.
especially given the history of, let's say, challenges in replicating China-only data in global trials.
Exactly. So our thesis is Takeda's valuation is kind of stuck in this LOE absorption narrative until something changes that perception fundamentally.
And that catalyst could be.
The first major global data readout for one of those Innovent assets, specifically IBI 363, the PD-1IL2 bispecific. If they can successfully replicate that impressive China data in the ongoing global phase 2 or early phase 3 trials,
Showing it works well and safely in tough groups like IO-refractory lung cancer or MSS colorectal cancer,
then the market simply cannot ignore it. That would be powerful validation of the huge external innovation bet.
So, the actionable plan. Consider going long Takeda ADRs ahead of expected early 2026 data readouts for that global phase 2 IBI 363 trial.
If the data hits, if it confirms what was seen in China, it shifts the whole story. It moves from managing decline to oncology reload, and that could force a significant re-rating of the stock multiple.
Right, because the narrative changes completely.
Okay, so wrapping up. Takeda is clearly navigating a tricky transition in FY25. LOE, FX pressure, it's real.
But they're using that strong cash flow and the big Innovent deal to try and reload the pipeline for acceleration starting in FY26.
The whole strategy really hinges on execution now. Science, logistics, commercial launches. And they did confirm they plan to manufacture the key Innovent assets in the U.S. and lead global development themselves.
Which seems designed to manage geopolitical risk while chasing that oncology growth.
It does. But the final thought we'll leave you with is this. Can Takeda successfully pull off this complex integration? Taking global leadership of assets developed externally, managing that massive Innovent partnership, while still digesting the VYVANSE LOE shock and fixing the Entyvio pen conversion issues.
That's the multi-billion-dollar question, isn't it? Successfully juggling all those balls will really define their path for the next 5 years or so.